Hey everyone, welcome back to Talk Tickers, where we dive into the earnings calls that are really moving the needle. Today, we're looking at HeartBeam. That's ticker BEAT. Now, their Q3 call was supposed to be this huge turning point for the company, but what actually happened afterwards, well, it turned into a complete plot twist that has put every single investor on edge. So that brings us to the big question, right? Was this quarter the moment HeartBeam finally took off? The real launchpad for their new cardiac tech? Or did it just pull back the curtain and show a company teetering on a financial cliff? Let's dig into the numbers and find out. All right, first up, let's take a look at the headline results. How did HeartBeam actually do compared to what Wall Street was expecting? And wow, right out of the gate, the numbers tell a pretty rough story. This was a huge miss across the board. The earnings per share came in at a loss of 15 cents. The analysts were only expecting an 8-cent loss, so they basically doubled that. And what's maybe even more important for a company that isn't actually selling anything yet, revenue was zero. The street was hoping for something, maybe the first glimmer of sales, but they got nothing. So yeah, a clean miss on both the top and bottom line. And this number, this is the one that really jumps off the page. A negative 87.5% surprise on earnings. Look, a miss this big isn't just some data point on a spreadsheet. No, it's a massive red flag. It's the kind of thing that really damages management's credibility with investors.
But as bad as that earnings miss was, it's honestly only half the story. If you really want to understand the kind of pressure this company is under, you have to look at the balance sheet. This is where things get, let's just say the situation gets incredibly tight.
So at the end of Q3, how much cash did HeartBeam actually have in the bank? Just $1.9 million. Now, let's put that number into perspective, because context here is everything. Because in that exact same quarter, the company burned through $3.2 million just to keep the lights on. Just let that sink in for a second. They spent more money in 3 months than they had left in their entire bank account. This isn't just a tight runway, folks. This is a full-blown 5-alarm financing crisis. This is what you call a classic pre-launch squeeze. They're spending more on R&D, up 13%, because they're trying desperately to get their product ready. And hey, credit where it's due. They cut back a bit on general expenses, but the net loss still got bigger, by about 6%. The bottom line here is just unavoidable. There is absolutely no way they can launch their product with the cash they have on hand. They have to raise more money. It's not a choice, it's a necessity for survival. Okay, so with that pretty bleak financial backdrop, you'd think management would be a little cautious, right? Well, not exactly. Let's look at the story they were actually telling investors on the call. Despite all those numbers, the leadership team came out with a very confident, very optimistic bull case. And really, their entire argument, the whole bull case, it all hinged on this one thing. The CEO, Robert Eno, basically said their upcoming FDA clearance, it's called a 510(k) clearance, for their new ECG software would be a major inflection point, the big catalyst. And he was crystal clear. He said they were expecting that clearance by the end of the year. And this was the roadmap they laid out for everyone. Step 1, get that all-important FDA green light. Step 2, start selling the product in early 2026. Focusing first on those high-end, concierge-style cardiology clinics. To back that up, they have a key partnership with a company called HeartNexus to handle the readings 24/7. And it's all supposedly protected by a strong portfolio of patents. It's a good story, right? It sounds compelling, if everything goes exactly to plan.
So, the big question is, did the market buy this story? It sure seems like investors were paying more attention to that scary balance sheet than they were to the optimistic presentation.
And you can see it right here in the stock price. The day after the call, the stock dropped almost 7%. Now look, that's not a total collapse, but it is a very clear signal of doubt from Wall Street. It's like the market heard management's rosy story, looked at the cash situation, and said, yeah, we're not so sure about that. And then, boom, everything changed. Just 13 days, 13, after that earnings call, the whole story completely fell apart. This timeline is just devastating for management's credibility. Think about it. On November 13th, the CEO is on a public call saying he's confident they'll get clearance by the end of the year. Then, not even 2 weeks later, on November 26th, the FDA basically says, nope, not happening. The official term is a not substantially equivalent letter from the FDA.
Now, for anyone who doesn't follow this stuff closely, let me be very clear. This is not a minor delay. This is a huge setback. An NSE letter means the FDA looked at their device and said, sorry, this isn't similar enough to anything that's already approved. It completely torches the entire timeline management had just promised to investors.
So you put all of that together, the bad earnings, the cash crisis, the FDA rejection. What's our take on all this? What should investors really be watching for now?
As we see it, the whole picture for HeartBeam now boils down to 4 massive risks. First, that cash situation. It's not a risk anymore, it's an outright emergency. Second, their path with the FDA is now a total question mark. They're basically back to square one. Third, they're going to have to raise money, which almost certainly means selling new shares at a low price and watering down the value for current owners. And finally, number 4, all of this makes the stock a complete gamble. It's a binary bet on whether they can fix their FDA problem and their money problem, and do it really, really fast.
So, when you combine a balance sheet that's on life support with a massive, unexpected slapdown from regulators, our rating here is underperform. The road ahead for HeartBeam is just full of huge obstacles. And frankly, we expect the stock is going to do worse than the overall market until we get some major positive news on both the FDA and the funding situation.
So that's our take on HeartBeam's very dramatic quarter. And just as a final reminder, this analysis is just for informational purposes. It is not financial advice.